Welcome everyone to the Investing with IBD podcast. It is March 22nd, 2023, Wednesday. We'll be taping today and dropping tomorrow on Thursday as usual. It's Justin Nielsen, your host. Joining me as he always does is Arusha Peiris. He is an O'Neill Global Advisors portfolio manager. How are you doing, Arusha? Looks like you're not the worse for wear on a Fed day.
Yeah, it's always interesting these Fed days, and it might look like we might be a little bit more waiting around and testing our patience.
Yes,
Until
exactly.
this market sets up.
Patience has been the name of the game for a while
That's
here.
right.
So we'll also be hearing this week from our special guest. Ryan Worch is joining us again. He's a hedge fund manager for Worch Capital. How are you doing, Ryan?
Good, guys. How are you? Always
Good.
exciting to come live on Fed Day.
Yeah, right, exactly. All sorts of fun, so you probably plan that ahead of time, right? Oh, you know what? Let me choose this day of all days. And an important one because we've been having a lot of situations with banks, and so this was kind of a big one where people were wondering how the Fed was going to handle it. So we'll get into that. But before we do, I want to give a quick disclaimer. The information provided by Ryan as an investment advisor regarding stocks is for educational and informational purposes only. It should not be construed as personalized investment advice and is not a recommendation to buy, sell, or hold any particular security or investment strategy. Did I do that okay, Ryan?
Nailed it.
Okay, perfect. Now we can move on with the legalese off to the races. Let's start. Where do you want to start? Do you prefer, when you look at the market, do you look at the S&P 500 as your go-to, or the leader lately has been the NASDAQ composite? Where do you want to start, Ryan?
Well, typically I focus on really three main indices: the NASDAQ, the S&P, and the Russell. We could probably pull up the NASDAQ and kind of look at that first. But there's really a common theme throughout all of this, and really what it all leads to is just a lot of distractions, a lot of noise with a lot of volatility. It's one choppy, sloppy mess, quite frankly. And it's interesting going through the charts today is if you look at the NASDAQ, it's above the 200. The S&P is dead on the 200, and the Russell is below it. So you have no real conviction in direction. So that's what makes this market very confusing. I'm sure it's hard for people that are trying to buy it, whether they're trend following or not. Buying any sort of strength in this market has been extremely hard. So you mentioned it in the opening. I mean, I think patience has been the best thing. You don't have to rush out and do anything. Being a fund manager, I manage other people's capital. The biggest thing that I have to focus on is preservation of capital. And right now, there's really no edge, I think, in the market from a directional standpoint. There are some areas, if we're looking at the NASDAQ right here, I think if you look at it, it's really gone nowhere for the last 2 months. But even if you back up further, which is kind of crazy to think about, the NASDAQ is essentially at the same price it was in August of 2020.
Oh wow!
Oh yeah, let's go to the weekly. Let's take that step back, right?
Yeah.
Look at that. It has gone absolutely nowhere. Now, it had the big overshoot as we ran up in late 2020, 2021, and then we had the bear market of 22. But price has not progressed in, over 2 years. If you pull up the S&P, it's very similar. Hasn't gone anywhere since, I think it's February of 21.
Right.
Very, very similar. So while there have been moves outside of the range, we're basically back to where we were 2 years ago. So it's been this year specifically. Last year was obviously hard, but last year, if you were a true believer in CanSlim and you followed trends and technical analysis, last year I think was actually easier, quite frankly.
Yeah.
Because it was a one-way train down. And if you sidestepped it and you listened to some indicators and you followed your rules, you probably sidestepped most of it. And that's what we were able to do. The markets were down between 20 and 35%. And I was down barely, almost flat for the year. This year's completely different. The markets, the NASDAQ is clearly outperforming. But it's been very hard to catch any sort of trend and momentum in the market. So it's again, I think the market's in limbo right here. And I think lots of cash, lots of doing nothing, lots of patience and sitting and watching and just waiting for the trends to kind of evolve is the best idea I can give.
Yeah. I kind of feel like it's really been since that October low that things were kind of a little tougher, I guess, because that October low we saw such a strong move from the Dow Jones Industrial Average, not an index that we normally pay as much attention to because it's only 30 stocks, but that was kind of the leader off the bottom. And so there was kind of like, hey, there are things that are working here and in a big way. But it just the breadth wasn't there. It was very select. And then January saw such a quick shift to growth, which normally we would love, but even that seemed a little bit short, right? All the trends seem short, and it seems like it's very tough to get much traction before the sector rotation and everything starts falling the other way.
Yeah, no, I agree. So where it really changed for me is I do a weekly call with a bunch of other hedge fund managers, and we all kind of talk about these things. And that's the beauty of the market, right? It's constantly changing. There's new information daily, and it's basically a giant puzzle that's never solved, right? And you're always trying to update your models with new information. So what changed for me was we had a momentum thrust signal on January 12th. And to me, that said, okay, well, I think I'm going to start taking a little bit more risk because if you look at those signals in the past, they lead to strong returns 3, 6, 12 months out. That's what we're looking for. And during that time, you saw a breadth kind of explode across the spectrum, from economically sensitive to high growth to it was kind of all over the map. Everything was coming along for the ride. Then things kind of started to change in early February and obviously here in March, where we've rolled over. And what's interesting, if you look at these breadth thrusts, there's some real interesting stats about them. The average pullback after 3 months is about 5.5%. This is from peak to trough within the move. We're at a 9.2% drawdown. So
wow. On the NASDAQ?
This is on the S&P.
On the S&P, okay.
This is where the data goes back further.
Okay.
The max draw, it's getting closer to that max drawdown. So we really haven't had any progress. The closing price on the S&P on January 12th, 39.83. I mean, really, we've gone basically nowhere since then. And the big thing that I've noticed since then is breadth is completely deteriorating. So if you look at the percentage of stocks above their 50-day on any of the indices, NASDAQ, S&P, Russell. The Russell's obviously the weakest, S&P's middle, NASDAQ the strongest. But look at those breadth metrics, call it, a month ago or the beginning of February. You had close to 80% of stocks trading above their 50-day moving averages. Now on the NASDAQ, 26%. I think the S&P is 18% and the Russell 2000 is worse. So, breadth has just fallen off a cliff. And that leads to, this market is extremely narrow. Even though the NASDAQ has held up well, if you had to break it down, it's only in probably a handful of stocks. It seems like money is just rotating into the biggest of the best, which is Apple and Nvidia and Microsoft. It seems like money's kind of hiding out in these big cap, massive cash flow, big balance sheet names that may be safe havens in the event that this financial crisis continues. That's what it seems to me. But overall, it's extremely narrow. And that's why it's really a bifurcated market, quite frankly. I mean, you have strength in NASDAQ related and growthy type stocks, even though it's very narrow, but then you have absolute weakness in any, financials, retail, energy, oil, biotech, real estate. And then on the flip side, you have strength in semis, gold, and then your big cap tech and bonds. So it really, there's some conflicting signals because, today, Fed day, markets sold off extremely hard, finished on their lows. 10 years sold off hard. So what is that telling you? That's telling you money's kind of preparing for a slowdown, recession, whatever it may be. But on the flip side of that, what's kind of contradicting that is, why are semis so strong? If we're going into a slowdown, semis are extremely cyclical. Why are they strong? So again, what I led off with, I think is exactly right. It's a lot of noise, a lot of distraction, and a whole lot of just nothing, where the market just kind of remains in this state of limbo.
So Ryan, getting back to the breadth thrust, where we had the signal, and then it started to kind of diverge from what was expected, with the market being strong 3 to 6 months from now. Are there any other examples where they start getting down to that lower end of the range, 9% off the highs for the S&P 500? Any other kind of other years that followed this type of scenario we're seeing right now?
There's a handful of them. I think in the early 80s, 82.
Okay.
One specific one was 62, which is just fairly similar to kind of right now. 62 was the Cuban Missile Crisis.
Yeah.
Now
I was just thinking about that.
I'm not saying we're going into a Cuban Missile Crisis, but we're having a crisis right now for sure. And it's a financial crisis, which could be systemic. We don't know yet, right? It's too early to tell. But there's a similar analog to that time period and now. And I think that had, a 15% drop peak to trough, roughly. What I do a lot is I look at current patterns, and then I go and look at prior time periods and try and compare and see what is the closest analog. So while we got that breadth thrust, I love knowing that leads to strong returns. But what happens if it doesn't? So another interesting stat at the same time, I don't know if you guys saw, but this is since 1950. After we went through a bear market, defined as a 20% drop, if the S&P got above the 200-day for a month after the bear market, it never went back to new lows.
Yes, I remember.
So again, that with the breadth thrust changed the character of the market for me. So I said, okay, I'm willing to take more risk now.
Mm-hmm.
It hasn't paid off, right? The market has kind of rolled over again. But once I saw that stat, I started doing my own research. If you look at it prior to 1950, there was a handful of times where the market got above the 200 for a month and rolled back over. And I've been, hammering this time period with my group I talk with every week for probably about the last 6 months. I still think this is like 1946 to 49.
Mm-hmm.
So, and why's that?
Well, you have a lot of similarities, not only in price patterns, but if you look at that time period, it's very similar fiscal and monetary conditions, very similar inflation influences. It had much higher, actually, inflation. This was coming out of World War II. Mm-hmm. We had 20% inflation then, but we had a lot of things line up, not just price related, fiscally related, monetary related, inflationary related, very similar. And what happened in that time period is essentially the market went nowhere for 2.5 years. It had these massive volatility spikes up and down, but the low was made in 1946 after a 25% bear market. It retested that exact low in 1949.
No way.
Yep. If you look at it, and so listen, I make the most money when we have a sustainable trend in either direction. Mm-hmm. I really hope we don't get into that period, but I have to know that is a possibility. That is a scenario that could be played out, and it has happened in the past. So, again, I don't make money predicting what the market is going to do, because quite frankly, nobody has any idea.
Right.
I make money being reactionary. Why this market remains so hard is being reactionary. You pretty much lost money, because if you've chased any sort of strength, you're probably, if you have any sort of risk management, you're probably getting stopped out within a day or a week or a few weeks very quickly at a loss. So that as a hedge fund manager, those are the things that we have to use, from a discretionary basis. And experience, I've been doing this for 23 years now, is why have I not taken a whole lot of risk this year? It's because quite frankly, it hasn't paid to take any. Mm-hmm. And we're going to get into some stocks later. But, if you just chase every breakout for the sake of breakouts, you have to keep it in perspective of where are the markets? Are they rewarding that type of strength? And I would say this year, and quite frankly, for the probably last year and a half, they haven't.
Right. Yeah, absolutely. And it's important to kind of just realize again what's working and what's not, and you have to play with different rules in different markets. There's always that sense of, look, in a bear market, not being so aggressive. I wanted to kind of get back to something though. There's some technical parts that you've been mentioning, talking about the 1949 coming to the 1945 lows, but there's also this macroeconomic component that you've been talking about, the fiscal policy, inflation. What's kind of your breakdown? How much do you rely on the technicals, that market breadth thrust, those type of things, versus what's going on in the macro picture?
So I'm not, I don't trade based off the macro, but I think you have to know it, right?
Mhm.
You have to know where you are in the cycle. I think that certainly helps. Um, when I'm deciding how much risk to put in the market, I would say most of it is, it breaks down between a combination of fundamentals and technicals. I think the number one indicator for me is, can I make money? I mean, it's my own P&L. My own
Yeah.
Right.
P&L tells me if this is a good market or not. I'm a big fan of the KISS principle, right? Keep it simple, stupid.
Mhm.
And I truly believe that. If I'm testing the waters by putting out some positions and they're immediately getting kicked out, I'm saying, whoa, let's back off a little bit. Let's just kind of let this play out. Let's be patient. And it's been extremely hard this year because you've had this kind of move up in historically the sectors that I make money in, growth. The Nasdaq has outperformed, but I'm underperforming just for the simple reason I haven't put on a whole lot of exposure, and when I have put on exposure, it's really I've been stopped out fairly quickly.
Yeah.
So I'm willing to kind of just sit and be patient.
Mhm. And I
Yeah,
would say
you're
that's
listening to
also
the
been the
market right
case.
there, right? You're listening to the market, and you're
Yeah.
also realizing you're not in sync with the market. Something's off. But you're not in sync with the market, and at that point, you don't want to push it.
Yeah,
Mhm.
100%. Listen, I truly believe nobody can consistently time the market with accuracy, right? But if you listen to the message of the market and you
Mhm.
follow a process and your indicators, that's how I adjust my risk levels and my exposures accordingly.
Yeah.
Just because the market may be on a buy signal doesn't mean I'm 110% long.
Right.
I have to be in sync with what is working. And I truly believe you don't have to be in the market 100% of the time. Cash is a position.
Mhm.
You're going to get a lot of people, and you'll see it all through Twitter when people talk about, well, if you miss the 10, 20 best days in the market, you're going to underperform drastically versus just if you just buy and held the whole time. That stuff is completely wrong. Because if you look at the same statistical analysis or the same stats, if you miss the worst 20 some days in the market,
Right.
you wildly outperform. So
Mhm.
it's really, Wall Street loves selling, and they do it very, very well. But they manage the data completely different to attract an audience, right?
Mhm.
So my job as a risk manager, first and foremost, I have clients that trust me with their wealth and they don't want to lose it.
Mhm.
So I can be patient and sit and wait for my opportunities. And when I don't have that fat pitch, I'm not going to swing at it.
Yeah. No, makes total sense. And when we come back, we're going to talk a little bit about what you were seeing in the technical picture for some of the stocks and how that kind of helps you avoid some of these crises. Stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen related subthemes. With clean hydrogen based energy expected to grow 5 times in the next 30 years, companies building hydrogen related businesses to generate power, heating, transportation, and more will likely thrive. And welcome back to the Investing with IBD podcast. It's Justin Nielsen, your host, along with Arusha Pierce, who joins me every week. He's a portfolio manager over at O'Neill Global Advisors. And our special guest this week, it's Ryan Worch. He is a hedge fund manager at Worch Capital. So, Ryan, let's talk a little bit about, how tricky this has been. And certainly one of the things that's on a lot of people's minds is the bank crisis. Seen a number of banks just fail outright, and it kind of seemed like this came out of nowhere. The media was talking about it, and it's like everything was fine. The roses were blooming and the birds were chirping, and it's like, for a lot of people, it's like, this is why you can't trust the stock market, because this stuff happens out of nowhere. All this selling is happening behind the scenes, and you just don't know as the retail investor that it's happening. What would be your response to that?
Well, it is funny because Silicon Valley Bank really went out of business, right, in a day and a half.
Yeah.
But if you actually have any sort of risk management, you would have avoided every one of these bank crises, and you probably would have avoided them about a year prior.
Right.
Mm-hmm.
So there was a great quote from Walter Deemer, who posts on Twitter. He's an old technician, but I thought it just summed this up perfectly. It said, no stock in an uptrend ever went bankrupt.
Mm-hmm.
And it's true. I mean, let's pull up Silicon Valley Bank. Silicon Valley Bank peaked in 2021, basically with the growth stocks.
Mm-hmm.
Most growth stocks peaked sometime in the fourth quarter of 21. Then it undercut it pretty violently, the 10 and 40 week moving average in January of 22, over a year ago. It never traded it back above that high, the breakout day week, the whole time. So essentially, it's been in a downtrend for 14 months, over a year before it went bankrupt. Mm-hmm. So you should have avoided this at all costs. If you had any sort of rules, you would have been out of this stock months and months and months ago. So risk management is so key. The problem that I see that happens to even some professionals, but a lot of amateurs, is they create a plan and they have these rules and they don't execute it.
Yeah. They'll
say, oh, I'll sell it when it comes back. Mm-hmm. They hate taking losses. First loss is always your best loss. That's what I say all the time. Mm-hmm. One of our mottos here at Worch Capital is win by not losing. Mm-hmm. So you can take a lot of small losses because you're going to have these big winners that are going to make up for most of your losses. You cannot take large losses because in this game, if you don't have any capital to bet with, it's just like in gambling. If you don't have any chips, you're out. You're done. Mm-hmm. You can't bet. So, again, risk management is probably one of my single biggest edges I have over everybody else.
Mm-hmm. Yeah, Ryan, I think that for most people, they have to go through maybe one of these scenarios where they ride a stock down, maybe not to zero, but maybe down 70, 80% to realize the importance of risk management. It's kind of like putting their hand on the stove and things like that. But where it's important after that is learn from it, right? That's what kind of makes the difference between those who survive for the long term in the markets and not.
It's funny you say that because I think we actually touched on this last podcast, and I learned that way too. And if you read a lot of the greats, they all had some similar experience. The best thing that ever happened to me is when I first got into this business, I had no idea what I was doing, and I was just buying whatever my bosses told me. Well, I'll never forget Nortel Networks gapped down like 60% on earnings, and I had pretty much my whole account in it, and I lost all my money. Mm-hmm. The best thing that ever happened to me was that loss, but I didn't have a lot of money at the time. It was all the money I had, so I felt the emotional stress of it, right. And I said, I never want that to happen again. Mm-hmm. And you have to have extreme discipline to execute that. And I think that's just one of my strengths is that, I have that discipline of taking losses, because if you don't, you're wiped out. And I'm at a point now where, 23 years later, I'm still in the business, and you just can't take those type of risks. So you have to say the market is smarter than me. And did the market sniff out Silicon Valley Bank going bankrupt? I have no idea. But it told me 14 months ago, I don't want to be long this stock. It's in a downtrend. Yeah. You've guys heard the old adage, nothing good happens under the 200-day. It's true. If you just stayed out under the 200-day, you would have saved yourself, a lot. Again, you would have gotten out of Silicon Valley Bank, up in the 500s?
Yeah, very beginning of 2022.
And it went to zero. And it's not like we haven't seen this before. I mean, this has happened, Enron, WorldCom,
Right.
Bear Stearns, Lehman
Bear Stearns.
Brothers.
I mean, there's tons of them. It happens in every cycle. So, this is why you have to have rules and you have to have risk management, because quite frankly, I don't know what's going to go to zero, what's going to go to Mars. I really don't. But if I have rules that I follow and I stay disciplined to those rules, I'm going to stay out of all of these nasty periods. No doubt about it. If you go, let's go down the list. Let's go to Signature Bank.
Mm-hmm.
Well, before we move on to that one, I just want to ask you a quick question on Silicon Valley here, or SVB. What do you say to folks that are like, okay, look, there was this huge opportunity here as this was skating around 200. We had the market make its lows in October, and if you were picking this up around 200, you could have ridden this to 340. I mean, that's a nice gain in a very short period of time. Are you saying we don't take advantage of those type of opportunities?
I'll let the Cowboys take those opportunities, and I don't want to be a Cowboy because I don't necessarily need to take those type of risks. Because if you look at that, I could have bought. Yeah, you could have made a decent amount, but there was a handful of stocks that were within spitty distance of their new highs. So if I'm looking for stocks that are holding up stronger relative to the general market, this would not have come up.
Mm-hmm.
Right? This is well below all-time highs. Look at all the moving averages trending lower. It wasn't above the 40-week. The volume pattern of it was actually bearish.
Yeah.
And look at all the big down volume. Look at all the red bars, right?
Yeah.
That's what I look for. And there's a lot of people. It's a different philosophy. It's a different strategy. They'll buy lows. I don't look for lows. I look for stocks around highs. That's what I'm looking for. Again, goes back to what I said. The perfect quote: "No stock in an uptrend ever went bankrupt." What defines an uptrend, right? You want the exact opposite of this.
Mm-hmm.
You want the 10, the 40-week, whatever you look at, whatever metric you look at. If you look on a daily, you want the 20, the 50, the 200. You want them trending up, not down. That's like as simple as it gets. There you go. There's a daily. Every one of these moving averages was trending down. Now, I guess you could have said, okay, maybe January, what is this? The 50 started trending upwards along with the 20, but you're still fighting a long-term downtrend with the 200 severely still sloped lower.
And you get right to that 200-day moving average line, and that's where you top out.
And it is funny if you go back and study all of the bear markets and the classic stocks that rolled over in bear markets. It is amazing how many of them will follow the 10 and the 40-week all the way down, and they're not buys at the 10-week; they're shorts.
Mm-hmm.
And this was a classic example. I mean, you could have shorted us every time it got probably to the 10 and then ultimately the 40, and you would have made a lot of money.
Yeah, especially that last time with the Cowboys. ran right up to 348 right there. It just touched that 40-week moving average, and that was it.
Yeah.
And they act as a barrier, and it's the exact opposite in a bull market. They will ride the 10 or 40-week on the way up, and they tend to be buys into those pullbacks.
Mm-hmm.
And it's the exact opposite when you get into a bear market. Those areas become sells, and it's this game is really easy in hindsight. It's like, well, I should have just shorted it at 550. And
right. Yeah.
But we have to make decisions in real time. So it is completely different. If you go on Twitter, everyone's a genius, right? Because they did this, they did that. Show me somebody that actually has real returns that's been doing this for, 20, 30, 40 years. Those are the guys that have staying power because most likely they have exceptional risk management.
Yeah. Even for those people that are doing the bottom fishing, there are successful people that do it, but they all have those risk management principles. There's got to be something that tells them, okay, rather than doubling down when I'm wrong, I got to know when I've got to cut and run. Do you want to go ahead? Oh, go ahead.
Well, I was just saying, I tell people all the time, it's like, my strategy, if you did the exact opposite of my strategy, you could still make money. How is that possible? Comes down to a couple things: position sizing and risk management. That's it.
Right.
That's it. Because I'm going to lose money, the majority of the time. I probably make money only a third of my trades. But how am I able to successfully make money and annualize, more than the S&P? It's because I let my winners ride. So my winners outgain my losers by a factor of 3 to 1. So it's if you break it down, it's like I said, keep it simple, stupid. It's not that hard. As long as you are able to keep your losses small and ride your winners, and you have enough winners, you can make money doing this. There's no doubt about it.
Yeah, let the math work for you. Do you want to go ahead and bring up a Signature Bank?
Yeah. So I mean, again, as we go through these, you're gonna see some common themes and characteristics, right? Once they broke down and entered their downtrends, there was absolutely no reason to be long these. And even more importantly, you had ample time to get out. Signature Bank, peaked in, again, late 21, maybe early 22, and then it undercut the 10 and 40 week in April. So, right in this area, once it undercut, it really never went back above. And this one never even got to the 40 week. This touched the 10 week all the way down. So I'm not saying like I had the foresight to know. I don't think anybody did. But if you just had simple rules and some risk management, you would have gotten out well in advance of all these. Yeah, you could have sold this in the 260, 270, 280 range. This is going to go to zero. May not be zero, but if they get bailed out or get bought or morphed into somebody else, but you would have saved yourself a lot of heartache. So common themes that, again, we can go to the next one. First Republic, that's kind of seems to be the one in the news headlines recently.
There's a little bit, yeah. I mean, at least this was going at a little bit less shallow angle, but still well below the 40-week line for a long
time. Yeah, look at that. Peaked in 21, broke down in late 21, early 22. Once it broke the 40-week, never back above it. Maybe it got back above it slightly at the beginning of this year, but, touched it and rolled over again. If you go to the daily, it'll probably show you a little bit better, the action. Still no reason to own this.
Right, exactly.
Yep, exactly. And listen, the stocks overshoot, right? In a bear market, they're going to overshoot the 50 to 200, and in a bull market, they're going to undershoot the 50, and they'll shake people out. So it's not like the exact number has to hold. You use these as general guidelines, really. And quite frankly, look at the trend of that. It's down the whole way. It is the 200-day moving average is trending down. And the 50 mostly is trending down the whole way.
And it's mostly underneath that 200-day for most of this time, right?
Yep, exactly. And then, again, maybe the poster child for this other than Silicon Valley is Silvergate. I think that was another one that got wrapped up in the crypto craze and went absolutely crazy to the upside. And, trades for the dollar stock now.
We got to adjust the scale real quick because it came down so much.
and look at that. I mean, same thing. Now this one kind of, jostled around. Once it broke it back above it, down below, but once it ultimately broke right there, never back above the 40-week. So, again, that was probably a year ago. Again, the common theme in here is, why do you want to own stocks in a downtrend? And I don't think you have to.
Right.
So I'm looking for relative strength, not relative weakness. And if you want to avoid the next bank crisis, it's as simple as that, quite frankly.
Mm-hmm. Yeah. Or
if you can avoid these, if you can avoid these stocks, right, you've eliminated a lot of the soul crushing, portfolio destroying type of events.
100%.
And I mean, it's, to a large degree, this was kind of what you said at the beginning of why 2022 was a little bit easier to sidestep was because this is what the market indexes were doing. I mean, the market indexes were, if nothing good happens underneath the 200-day moving average line, that's where the indexes were stuck the whole
Mhm.
time of 2022. They would come up right to that index, I mean, right to that moving average, and then, get turned away, like almost, to the penny sometimes,
Right.
it seemed like.
And quite frankly, in 22, I was actually outperforming because I was short the market for the first half of the year. And
Oh, okay.
then once we bottomed in the summer,
Yeah.
what did it do? It chopped around.
Yeah.
Yep.
And basically, I just kind of gave back the profits I had made on the short side for the first half of the year. So a trend in either direction is profitable. You should be able to
Mhm.
get on the trend, whether it's a bear market or bull market. It's these choppy, trendless ranges that are really the hardest for anyone that
Mhm.
uses trend following as part of their methodology.
Yeah. You need a trend to follow. Absolutely. Well, hey, that's great stuff there. And I just did a little talk with Ali Coram on Barron's Live, and it's funny because we were kind of talking about similar things. If you look at Enron, you look at Bear Stearns, you look at all of those, there were warning signs of weakness months in advance before the scandal comes out. And um, you know, uh, Bill O'Neill used to have a idea service that he would give to institutions, and Enron came off their list. It was on the new stock market ideas list, and it came off like November 29th, 2000, at like 76 or something like that, long before the scandal happened or any of the news came out. So, yeah, it's definitely a way to get ahead of the curve. The technical action, absolutely, kind of there can be a lot of these that do come back after this devastation, these bad breaks and everything like that. But there are those that don't, and it's as Arusha said, avoiding the ones that don't. I mean, that's worth a heck of a lot. So when we come back, we're going to talk about some of the stocks that are on Ryan's radar right now, potentially setting up. So stay tuned. We'll be right back.
The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive.
Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, your host, along with Arusha Pires, who joins me every week. He's an O'Neill Global Advisors portfolio manager. And our special guest this week, returning back to the podcast, is Ryan Worch. He is a hedge fund manager at Worch Capital. So, Ryan, let's talk about some of the stocks that you think are setting up. And it certainly has been, as you said, not the best in terms of breadth, but there are these pockets of strength. So definitely like a stock picker's market right now. But maybe we start with On Holdings, and I don't know if you can do it again, but you showed us at the break that you had on you had on some On shoes. So I don't
I,
want you to pull something though.
I am wearing them,
Yeah,
and I'm I use the product, and this is one of the things. I don't know if you guys have read the Peter Lynch book, but
sure.
he talks
Mhm.
about observing the trends around you, and I certainly have seen that. I just went to my daughter's soccer tournament down in Virginia Beach, and I would say every middle-aged man from 35 to 55 was wearing, the on cloud shoe, and
Hmm.
you just see them more and more everywhere you go. And I'm thinking to myself, like, wow, this is starting to sprout up everywhere. It's kind of like with Teslas. They start exploding,
Right.
and everyone was
Right.
driving Teslas.
Right.
But it helps when you actually enjoy the product and you use it. So, this is one I kind of had a little bit of conviction in. Unfortunately, I don't own it. I had owned it, and I sold it for risk management purposes prior to this massive breakout I just had on earnings. But it goes back to, where we are in the market. The market has not been rewarding buying these breakouts. So I didn't go and chase it. I watch it. I'm gonna try and get a position in it as it consolidates. But listen, part of the group I do talk to are I'm sure you guys probably know some of them, but Eve Bobach and Kathy Donnelly and Eric Kroll,
Yeah.
Dale.
Mhm.
I want to give them some credit because they kind of wrote the book on IPOs, and this is a recent IPO. And this just potentially had a super breakaway gap from its first mature base out of its institutional due diligence phase. And I had been watching it because it had this monster move up on the IPO, came back, and it's really had this really nice basing structure here for the majority of the year. And then lo and behold, it has earnings and it just explodes on volume. What's interesting about the volume is the volume was 9 times average, but it was 2 times more than on the day of the IPO. That's very rare.
Right.
Very, very rare. So if you go and pull back a weekly, you'll be able to see it.
Yeah, you can see that weekly volume is just.
Yep. And we're only, this is Wednesday, right? So we still have 2 more days. So that just shows you just extreme strength, and people are just piling into this thing. It has fantastic numbers. I mean, it just put up a 90% revenue number this quarter. The prior 4 quarters have all been strong. Contra has a position in it. I mean, it's got earnings growth, it's got revenue, it's got all the metrics from a fundamental standpoint that I like. On top of it, again, I like the product. It's a newer merchandise from an IPO recently. These have all the characteristics left. Now, do I wish it were, maybe closer to highs? Yes, but I would say because the base has formed after it formed its institutional due diligence phase, I'm confident that with the volume and price move, that this could have the potential to move up over the next, few months. And I think this has a chance to outperform. So this is something I don't own, but I'm going to look at getting in a position. And the reason typically I would be buying this breakout, no doubt, I'd be buying it hand over fist the day of the move. But because the market hasn't been rewarding these type of plays, I mean, Airbnb was similar to this a month ago, gapped up, went up a second day, and then erased the whole move and then some.
Yeah.
So I'm going to wait. I'm going to be patient. I'm going to try and build a position in this as it potentially maybe forms a secondary base, a flat base, whatever it may be. But that's one I'm watching. It's on my watch list. I will say my watch list right now, we talked about the market being narrow, is on the smaller side. So even my watch list is very narrow. So the general market, just there's very few opportunities. This happened to be one of them. So one to watch for sure.
Now, did you discover this stock by observing all the middle-aged people at the soccer games, or was it they just come through screening in some other way?
A lot of it was screening, and then once I had it on my watch list, then I started noticing it. Quite frankly, I did own them, but I never, the stock, quite frankly, didn't interest me for a while because it kind of was in its IPO death fall here with the rest of the market.
Right.
Anything that had a valuation just got tomahawked, and this was one of them. And they kind of market themselves as a premier shoe. It's expensive. I mean, their shoes are $150, and their valuation to that extent was a little rich. I do lean on my background where I worked as a financial analyst way back in my career, so I do have that fundamental side to me. I don't use valuation as a big criteria, but I am aware of it, and that really helped last year because if you knew that with rates rising, what's it going to hurt the most? Anything that had a high valuation associated got hammered. I mean, I'm talking these things were down 50, 60, 70, 80% in some cases. And this kind of got thrown, the baby out with the bathwater. But they've put up just tremendous numbers through the face of a bear market. So they're clearly on to something. I think they're trending. I think people are buying them. They even talk about inventory being sold out. So it has what I decide to buy is different than where I decide to buy, right? I'm looking for stocks that are fundamentally strong. They have some sort of story or product. That's what I look for first. And that is done through screening criteria. And I use Market Smith to do a lot of that. And then where I buy is really technically inclined. So I'm looking for inflection points. This just so happened had one. I'm just not in a real fond mood of chasing strength right now, to say the least.
Well, and what I like about, kind of how you started the whole conversation, it wasn't like you said that you were in it, You got out of it because of risk management rules, and now you're not getting back into it here because of rules again. And it's acknowledging that yes, you are missing something, but sticking to your rules, is just, I think, evidence of that discipline that you have to bring to the table.
This is just really the frustrating part of the business, right? I mean, you have to stay disciplined. And I owned it. I had a good sized position and it's at $21. I sold it at 20. I took my loss because it hit my threshold. That's as much as I was willing to risk at that time. It hit almost 30 today. You're always thinking, well, God, if I'd kept it, I would have made X amount. But you can't think that way. Like, there's going to be plenty of these through my lifetime. That's the best part about what we do. Like, every day there's an opportunity. Every year there's an opportunity. I mean, if you miss one, there's going to be hundreds of other ones. Like, I'm 100% confident. Even if I miss this, there's going to be another big mover that I'm going to make lifetime changing money. That by far the best thing of what we do. Every day, you never know when the next opportunity is going to present itself. And as long as you're prepared and you take this serious, you're gonna catch them. You're gonna ride the wave.
Yeah, it does feel like a matter of time, right? Just you do it long enough, and you're gonna get some of those big winners. But yeah, go ahead, Arusha.
Yeah, well, first, I mean, you're just gonna see them enough that things are just gonna kind of feel very familiar, but they'll be slightly different to keep you on your toes for sure.
Right.
But what about one of the kind of questions I've gotten for stocks like this and a number of retail stocks are, hey, this stock is heavily shorted. It's only going up because it's a heavily short interest. Did you take any of that into account?
I mean, quite frankly, I like stocks that are shorted because it gives them the power people have to cover. Yeah. The one thing I didn't like about this stock, it's a lower price stock. Okay. So again, for me to get any sort of size, it really my position sizing in it was tough because it's harder to get a bigger position in a lower price stock. It just is. That was kind of one of the knocks I had on it. You go through the pros and cons. But yes, I like stocks that are shorted that have formed a basing structure because it gives it that power that they're going to have to cover. Again, rules have changed since when I first got into this business. Regulation was a Fed D. When that came out, prior to that, companies could talk freely to analysts and tell them if they were going to beat the quarter or not beat the quarter. So I think the difference now in today's day and age, you get all the information at once and people have to decide, if you have a big giant beat or a big miss, you're going to see it showing up. And this is why you have these massive gaps in these volumes. Right. People either go and cover or they're going to chase and buy because they want to get a position because now they're presented with new information.
Yeah.
So I think that's why. And if you have a stock that is heavily shorted, it's only going to add power to it. And that's probably why the volume has such a massive spike.
Now, does the fact that this is off so much from its high, so still has overhead supply that it has to get through, and even as much as it's down, it still has a PE ratio of 94. That's over 5 times what the S&P is. Is that troublesome for you on the valuation fundamental side of your background?
Yes, for my background, but I also have to know I have to separate that a little bit. That valuation is much more a secondary indicator to price and volume, quite frankly. Yeah. Would I prefer it to be not overly valued? Yes, but I've seen stocks that are overly valued go up for 5 years. I mean, Amazon was overly valued for 10 years. Yeah. So that is much more secondary nature. Listen, valuations ultimately matter, and they did. That's right. That's what happened in last year's bear market. Valuations finally, people decided they matter. When they decide to matter, who knows, right? Right. A lot of it does have to do with interest rates, and in a zero interest rate environment that we were in for close to a decade, it didn't really matter.
And a lot can happen before it matters.
It matters until it doesn't matter. That's really as simple as it gets. So, yes, would I prefer this to be closer to highs? Yes, but I mean, look at it from a relative strength standpoint. It has a 97% rating. The 50, was back above the 200. The 20 was above. I mean, it was starting to trend up. The 200 was kind of flatlining. When we go back through the other models of Silicon Valley Bank, the 200 was in a death spiral lower. This is flatlining and turning up. So there are some stark differences for sure.
Mm-hmm. Well, let's go ahead and switch gears a little bit from shoes to the ethical drugs. And Novo Nordisk, good old Danish company. Of course, this one is known for its diabetes treatments, but now it's kind of getting in the news a lot because of some of those treatments being used for obesity. What's your take on the fundamentals on this and the technical action?
Yeah, I mean, if they're basically right the leader in diabetes and obesity therapeutics. If you've seen any commercial, the catchy Ozempic commercials, this is what they do. It's one of the fastest growing drug companies on the strength of its GLP-1 franchises. Look at the sales in this thing. It's not your typical, super growth stock that I prefer, where I like things growing at 25, 30, 50%. But this is a massive company. I mean, this is one of the biggest companies out there from a market capitalization standpoint.
Yeah.
Mm-hmm.
That one of their products, Wegovy, their sales are going to more than double this year. This is an interesting, I presented this idea to my group months ago, but one of the interesting things that came up in my research was that 74% of adults are classified as either obese or overweight. That's staggering. So the addressable market for this is massive. It's massive. Morgan Stanley projects the market for weight loss treatments expect to reach $54 billion in 2030.
Mm-hmm.
I mean, that is just, and they are at the forefront of this. They're probably one of the leaders in this space. Right. Now, from a technical, the fundamentals all really line up. They're estimated to grow earnings 31%. Yes, would I like to see revenue numbers a little higher? Sure, but I'm willing to sidestep that for a minute because they're going to grow earnings 31% this year. It's going to slow down to 14% next year based on the estimates. But from a technical standpoint, it's extended. So I'm not going to go out and chase it and buy it right here. It is attempting to form some sort of flat base. It broke out to new highs yesterday, and what did it do today? Sold off with the market. So right. Another one I'm watching. I love it from a fundamental perspective. I want the technical and the chart structure to line up and give me a point where I have reduces my risk versus my return. That's what I'm kind of looking for. It's another one to keep on your watch list. It's in my watch list. Watching it, I'm being patient. I'm going to wait. But like I said, from a fundamental standpoint, it really is a leader in this space that is exploding. Mm-hmm. The amount of people that are obese in this country and around the world is massive, and they actually have a drug that is working to reduce that.
Mm-hmm. And not only that, but it's kind of one of those things that you have to keep on taking. So, it's kind of a built-in revenue stream. Like, it's not just one and done type thing. So,
and it's not cheap either.
Yeah, right. So speaking of things that are extended and really kind of blowing the doors off, let's take a look at Arista Networks. Ticker symbol is ANET, ANET. This just really, it had this kind of long period of basing, and when it just came out, man, it hasn't looked back.
That's the bifurcation of this market, right? You have Arista Networks that is making new highs versus banks that are making new lows. Right. So it's a conflicting market for sure. But again, I usually start all my research from a fundamental standpoint, and they label themselves as an industry leader in data-driven client-to-cloud networking for data centers and routing environments and campuses. Essentially, in a nutshell, they help companies connect faster using these specialized switches. And what is only exploding more and more data, right? Just more data with everything, especially now with AI. Data is not going anywhere but up. Mm-hmm. These guys help make it faster, quicker. And on top of that, look at their quarterly revenue numbers the last handful of years over. 28, 31, 24, 27, 31, 49, 57, 55. This is impressive, for a $50 billion company. But what's even more impressive, look at the up-down volume ratio, 3. How often do you see that, especially in a market like this?
3.6 actually.
3.6 now. Yeah, over 3. It's fascinating. I mean, look at if you pull up the weekly, look at just the blue skyscrapers on this thing.
Mm-hmm.
I mean, that is super impressive. That's just a wall of blue. And those are the subtle things that we're looking for. Again, it's too extended right here. I'd be looking for a pullback to get a position or add to my position. But again, this has everything that I look for. It's got the fundamentals. It's got, I mean, look at the relative strength. It's outperforming wildly.
Yeah.
And it's outperforming on people piling in on volume. So this is everything that I look for. Yeah. It's expensive too, but some of these things stay expensive for a lot longer than people expect.
And get just more expensive. The valuations continue higher. And look, I mean, this has got an EPS growth rate, an annual growth rate of 8%. A little bit lower than the 20-25%, but in this market, that's pretty gosh darn good. And the earnings stability is 11. So the fact that the earnings are that stable for a tech company like this,
so that's unusual.
That really is.
That low of stability.
Yeah, and remember that earnings stability is 1 to 99, the lower being more stable in this case. So that's remarkable.
What is even more unusual is that the bear market last year hit high valuation growth stocks the most. And this thing is at new highs, well before the general market. That's telling you something alone. There is huge power behind this thing. So I think that, again, these are the subtle things you have to pick up. But if you just run a simple relative strength scan, there's a handful of these semiconductor stocks that are just outperforming. Why? We don't know. In hindsight, you'll know it'll be very easy. But I think this is one you got to keep an eye on.
Yeah. Well, and to your point, kind of sticking with those relative strength leaders is a good way to kind of find stocks like this. And not only do you find stocks like this, but you avoid the SVBs, the signature banks, the Enrons, the list goes on and on. The relative strength really does tell you something, and that's why we always go for that leader versus laggard. Ryan, it was really great having you on the show. Thanks a lot for coming back. For people that want to follow you, Twitter is maybe the best, at Worch Capital. Yep. So WORCH Capital. Wonderful. And so thanks a lot, and we'll be looking forward to seeing you again. Thanks again for the ideas and the thoughts.
Great, guys. Thanks for having me. It's always fun.
Okay, and that'll do it for us this week. And next week, I'm going to be on vacation. I'm going to be on the beautiful island of Oahu. My daughter is looking at going to the University of Hawaii, so we'll be taking a tour. It's also her 18th birthday, so going to be wishing her a happy birthday. And I'm going to be on a plane on my way back to you, Arusha, on Wednesday when we normally tape. But never fear, Scott St. Clair is here. The patron saint of stocks. He will be taking my place as a guest host, so he'll be keeping Arusha in line. Someone's got to, and so hope you guys enjoy yourselves next week.
Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.